What if I told you that um, like 2/3 of the code that's running your dinner delivery tonight wasn't actually written by a human being?
I mean, that is just, it's a wild thing to wrap your head around.
Right. And, what if I told you that single bizarre fact is currently masking this massive failure in traditional business metrics? Like, it's actually making Wall Street cheer for a company that, technically speaking, just missed its earnings.
It really just completely warps how we measure success in, the modern economy.
It really does. So, well, welcome to NovaStream, your 24/7 streaming channel on YouTube. We are so glad you're tuning in with us.
Yeah, thanks for hanging out.
If you've been watching the channel today, Thursday, May 7, 2026, you already know what we do here. We are the anchors tracking the pulse of the world, basically right as it happens.
Right.
On your screen, you've got our live crypto markets feed, tracking Bitcoin, Ethereum, and Solana with those dynamic sparkline charts. You've got the global financial indices flashing instant updates on the S&P 500, NASDAQ Q, Forex pairs.
All the heavy hitters.
Yeah, all of it. And of course, you've got our auto-curated breaking news feed delivering headlines the absolute second they hit the wire.
But right now, we're taking a deliberate step back from those real-time tickers.
Yeah, we're hitting pause on the raw data feed to bring you the highlights of the day. We're going to, synthesize the biggest moves in tech, global currencies, politics, corporate shakeups.
And really, the underlying thing today is this wild collision between the frictionless, automated world of high tech and the incredibly messy, stubborn reality of human behavior.
So true. We've got tech stocks partying like it's 1999. We've got a massive $30 billion currency intervention over in Japan, and this really ruthless political revenge campaign reshaping the map in Indiana.
It's basically the ultimate stress test. We are watching perfect digital systems collide with very imperfect physical realities.
So let's unpack this tech rally first, because the numbers coming across our global indices tickers are, well, they're frankly staggering.
Yeah, they really are.
The NASDAQ Q Composite and the S&P 500 just hit new all-time highs. But here's the specific stat that literally made me drop my coffee this morning. The 10 top-performing NASDAQ 100 stocks are up an average of 784% over the last year.
Wow. I mean, it's a parabolic move. It just forces everyone to completely recalibrate their models.
And the chip makers are leading the charge. The PHLX Semiconductor Index just had its best 25-day rally, up 54% since, get this, March of 2000.
Right, March 2000. That date carries a lot of baggage.
Yeah, it does. And for anyone who isn't familiar, the PHLX is the Philadelphia Stock Exchange Semiconductor Index.
Yeah.
It's essentially the global scorecard for the microchip industry. So when I look at that 54% surge and I look at the date of that last record, March 2000, I instantly think about the dot-com bubble.
Naturally.
So I have to push back a little on this enthusiasm. Is this market just a 1999 cover band, or are we genuinely listening to an entirely new genre of music here?
Well, I'd say it's a new genre, even if the bass line sounds, terrifyingly familiar. If we rewind to 1999 and 2000, that entire bubble was built on hollow speculation. I mean, companies were going public simply because they had a .com in their name.
Oh, absolutely. They had, vague business plans, those flashy Super Bowl ads.
Yeah, the sock puppet.
Yes. And zero actual revenue.
Exactly. They were selling the promise of eyeballs instead of actual dollars. But the architecture of today's rally is fundamentally different. It's being driven by undeniable profit generators.
Like who?
We're talking about heavyweights like NVIDIA, Microsoft, Alphabet. The AI boom isn't theoretical vaporware. It's supported by massive capital expenditures on physical AI infrastructure and real earnings.
Right, like that 65% revenue jump we recently saw from NVIDIA?
Yeah, the cash is real. It's not pretend.
Okay, the cash is real, but let me play devil's advocate for a second. S&P 500 profit margins are currently double their historical average.
They are.
And to a layman, double profits sounds fantastic. But capitalism doesn't really let you sit at double profits forever without a catch, right?
No, it absolutely does not. And that brings us to the law of financial gravity, which is mean reversion.
The rubber band snapping back?
Yeah. When margins are double the historical average, it means one of two things is going to happen. Either those massive, juicy margins invite fierce, aggressive competition that drives prices down.
Which is how it's supposed to work.
Right. Or it signals that companies are squeezing an over-leveraged consumer base that will eventually snap and just stop buying. So eventually, extreme deviations pull back to the mean.
So even if the AI engine is real, the valuation might just be running way too hot.
Precisely. Analysts are waving red flags right now, warning that this extreme valuation could lead to a 25 to 30% pullback in these high-flying chip stocks.
Wait, 25 to 30%? That's a huge haircut.
It is, because these companies are currently priced for perfection. We're talking about major players like Intel, which just saw a 13% gain, pushing its market cap to roughly $544 billion.
Wow.
Along with SanDisk, Western Digital, AMD. If there's even a slight hiccup in their earnings, the drop could be severe because, well, perfection is already baked into the stock price.
Let's actually zoom in on how that AI engine is generating real-world value to justify these prices. Because, we saw Fortinet's stock absolutely rocket higher after their Q1 earnings.
Well, yeah, they crushed it.
They beat expectations across the board. Revenue was up 20% to $1.85 billion, and billings were up 31%.
This is a crucial pivot for the cybersecurity sector. For a while, there was this lingering fear in the market that generative AI would empower hackers to such a degree that it would just completely disrupt traditional cybersecurity firms.
But instead of disrupting them, AI is fueling them. Fortinet reported this horrifying statistic in their call, a 389% year-over-year increase in ransomware victims.
Nearly 400%. It's a bloodbath, especially for small and medium-sized businesses.
It really is.
It's a highly complex threat environment right now. Hackers are using AI to automate their attacks, find vulnerabilities faster, write better phishing emails. But Fortinet isn't just sitting there reacting. They are fighting fire with fire.
Right, they launched those new FortiGate series routers.
Yeah, the 3500G and 400G series. It specifically uses AI as the architecture to defend the enterprise. CEO Ken Xie talked about converging networking and security.
What does that actually mean, though?
Well, they're essentially embedding AI directly into the traffic routers of the network. So it's inspecting data in real time using the exact same technology that hackers are using to build an impenetrable shield.
Which totally explains why investors cheered that beat and raise quarter. It makes logical sense. But here's where the narrative gets really strange, and where we need to talk about that DoorDash stat I mentioned at the top of the show.
Yes, DoorDash.
DoorDash shares soared 11% in pre-market trade to over $187.
Which is a massive jump for a food delivery platform.
It is. But let me read you their actual quarter. Their revenue missed expectations, coming in at $4.04 billion. Their total orders missed. Their profit declined to $184 million.
Ouch.
And on top of all that, they're spending over $50 million a quarter on a gas relief program for their drivers because fuel costs are just hurting their fleet so badly.
Yeah, the friction there is huge.
By all traditional old-school business metrics, that is a rough, highly frictional quarter. Why on earth is Wall Street cheering an 11% gain?
Because Wall Street has stopped looking in the rearview mirror and is staring intently through the windshield. Yes, they missed those immediate backward-looking targets, but their forward guidance for Q2 was incredibly strong. They projected their marketplace gross order value between $32.4 billion and $33.4 billion.
Okay, so they expect a massive surge in heavy demand. But still, how do they service that demand profitably if their current operations are dragging?
That's where DoorDash's CEO, Tony Xu, dropped the bombshell you teased earlier. Nearly 2/3 of DoorDash's code is now written by artificial intelligence.
2/3. I mean, just think about that. The app, routing your driver, updating your map, processing your payment, it's mostly generated by machines.
It represents a staggering productivity gain. When AI is writing the code, the company can roll out new features exponentially faster. And they can operate with a drastically leaner engineering team in the future.
Saving a ton of money on payroll.
Exactly. Or, well, absolutely. Furthermore, investors are looking at the mounting hype around autonomous drone and robot delivery. DoorDash is positioning itself as a leader in a space that represents a potential $16 billion annual global profit pool.
Oh, wow. So they don't even care about the current gas prices.
No, the market is happily ignoring the short-term friction of spending $50 million on driver gas relief because they are aggressively buying into a future where AI writes the software, drones deliver the food, and human friction is entirely engineered out of the process.
They are pricing in a frictionless utopia. But here's the transition we really have to make, because you can code away a delivery driver, but you cannot code away macroeconomic reality.
No, you definitely cannot.
While U.S. tech margins are running double their average, that immense economic heat in the States is absolutely crushing foreign currencies. Let's look at the NovaStream Forex pairs, specifically the Japanese yen.
The moves here are monumental, and they highlight the limits of national economic control. On May 7th, Japanese authorities likely executed a second massive round of currency intervention.
Massive is almost an understatement.
Yeah, we're talking about an estimated 4.68 trillion yen, which is roughly 30 billion US dollars dumped directly into the open market to prop up the yen. And this comes just days after an initial $34.5 billion intervention on April 30th.
I want to break down the timing of this too, because they utilize the Golden Week holidays in Japan. For our listeners who, don't trade Forex, why does a national holiday matter for a currency intervention?
It's all about market liquidity. During Golden Week, domestic Japanese markets are closed, and a lot of institutional players are offline. So when there are fewer buyers and sellers actively trading, which is what we call thin liquidity, any large block order will move the price of the asset much more drastically.
That's pretty clever.
It is. By dumping $30 billion into a thin market, the Ministry of Finance ensures they get the maximum possible impact for every single dollar they spend. They were desperately trying to defend a psychological threshold of 160 yen per dollar.
But let me throw an analogy at you, because we have to look at the mechanics of why the yen is falling in the first place. The root cause is the massive interest rate gap between the U.S. Federal Reserve and the Bank of Japan, right?
Yes, that's the core issue.
U.S. bonds are paying out high yields, while Japan's interest rates have been parked near zero, and capital naturally flows across the globe to wherever it gets the highest yield.
Right. It chases the return.
So if the interest rate gap is the actual problem, isn't spending $30 billion in a single day like trying to put out a roaring forest fire with a garden hose while the wind keeps blowing the flames right back at you?
The market data proves your analogy perfectly. The success of Japan's intervention was incredibly short-lived. They sprayed the garden hose. They managed to push the yen to a 10-week high of 155.04, but the wind immediately blew back.
Wow. So it didn't even hold.
No, capital kept flowing to U.S. yields, and the yen weakened again. Analysts are calling it a high-stakes war of nerves between the Japanese government and massive institutional market speculators.
But how long can they keep that up? Dropping $30 billion a pop is a really quick way to empty the treasury.
Well, Goldman Sachs estimates Japan still has the foreign reserve firepower for about 30 more interventions of that exact size.
30? Oh my gosh, they have a deep war chest.
They do. But you hit the nail on the head. It doesn't fix the underlying fundamentals. All eyes are now looking ahead to the Bank of Japan's June meeting. The only way to actually put out the fire is to raise their own interest rates and close that gap with the U.S.
So we have the yen requiring multi-billion-dollar lifeboats and traditional fiat currencies feeling incredibly fragile under the weight of U.S. monetary policy. It really shouldn't be a surprise that capital is desperately looking for an alternative anchor.
Let's look at our live crypto markets feed.
Yeah. Bitcoin is currently eyeing that $85,000 mark. But, the raw price is almost less important than the mechanics of how it is getting there right now.
Because the narrative has shifted completely from the early days of crypto.
Completely.
This isn't the retail-driven social media frenzy we saw a few years ago. You have to look at the spot Bitcoin ETF flows. A spot ETF allows traditional investors to buy shares that track the price of Bitcoin, but the fund actually has to go out and buy and hold the physical Bitcoin to back those shares.
Right, so it locks up the supply.
Yes, it takes it off the market.
Which brings traditional Wall Street stability to what has historically been a super volatile asset.
Yeah, look at what happened this week. The BlackRock Bitcoin IBIT ETF captured $136.6 million in net inflows during a week where the broader Bitcoin ETF market was actually bleeding capital for 3 straight sessions.
So while other funds were losing money, BlackRock's ETF was just vacuuming up capital from institutional investors.
And it culminated in a massive Friday surge, bringing the total week net inflows for spot Bitcoin ETFs to $162.8 million.
It fundamentally changes how you have to look at the asset. The price action isn't just about anonymous whales moving wallets in the dark anymore. It is being heavily anchored by traditional Wall Street ETF flows.
Yeah, crypto has essentially been absorbed into the traditional finance machine. The rebels wear suits now.
Yeah. The rebels wear suits. It's so true.
It's an institutionalized asset class now, complete with all the corporate machinery, the lobbying, and structural support that implies.
Which brings us perfectly to our auto-curated breaking news feed. Because we just talked about algorithms trading Bitcoin ETFs and AI writing code for DoorDash. The digital world is humming perfectly. But the real world outside those data centers is still full of intense biological and emotional friction. Humans change their minds, they hold grudges, they get sick.
And that messy human element constantly derails perfect corporate strategies.
Let's start with consumer tastes. Beyond Meat, we just saw their shares sink more than 15% post-hours on a really weak forecast.
This is a fascinating case study of consumer behavior actively resisting a tech-driven food trend. A few years ago, lab-engineered plant-based meat was heralded as the future.
Oh, it was everywhere.
But consumers and restaurants are simply avoiding it now.
Why the sudden reversal, though? Is it just the high price point at the grocery store?
Price parity is definitely an issue, but it's deeper than that. There's been a cultural shift back toward whole foods. Consumers started reading the long, highly processed ingredient lists on fake meat and decided they would rather just eat actual vegetables or traditional protein.
Fair enough.
The demand has stalled out so severely that Beyond Meat is being forced into a radical rebrand. They are changing their name to Beyond the Plant Protein Co.
Wow, that is quite a mouthful.
Yeah, and they're attempting a massive pivot into the protein drink market.
Which is an incredibly crowded space dominated by established fitness brands.
Yeah.
It just goes to show that you can engineer a scientifically perfect plant-based burger in a lab, but you cannot force a human being to actually want to chew it.
Right. It's biological friction.
Now, let's look at another kind of friction: political tribalism. And as always, we're just looking at the structural mechanics here, reporting the facts neutrally. We are seeing major shifts reported across the country today. Over in California, the governor's race primary is looking incredibly chaotic.
Very chaotic.
California uses a top-2 open primary system. Let's unpack that for a second because it completely changes how these politicians have to campaign.
It forces a totally different strategy. In a traditional primary, Democrats run against Democrats and Republicans run against Republicans. But in a top-2 open primary, all candidates are on the exact same ballot, and the top 2 vote-getters advance to the general election, regardless of their party affiliation.
So you could end up with 2 Democrats or 2 Republicans facing off in the finale.
Yes, which changes the math entirely. Recently, one of the leading Democratic contenders, Eric Swalwell, resigned from the House and dropped out of the race entirely following misconduct allegations.
And in the wake of his sudden exit, the polling has completely shifted. Currently, a Democrat has been holding one of the top 2 spots in 8 of the last 10 polls, running alongside the 2 major Republican candidates, Chad Bianco and Steve Hilton, who are basically battling for that second slot.
It's a highly fluid situation, but if you want to see how intense internal party dynamics and leverage can get, look at the primary results coming out of Indiana.
Yeah, let's talk about Indiana.
Former President Trump just executed a highly coordinated and ultimately successful revenge campaign against incumbent Republican state senators.
State Senate races don't usually make national headlines.
Yeah.
What is the mechanism of leverage here? Like, what actually sparked this whole thing?
It traces back to a highly technical administrative dispute last year. Trump ordered Republicans in several states to perform a mid-decade redistricting. The goal was to aggressively redraw congressional maps to eliminate Democratic House seats ahead of the midterms.
Okay.
States like Texas and North Carolina complied with the directive, but in Indiana, a group of Republican state senators balked.
Why would they push back on their own party?
Their argument was mathematical. Their existing map already gave the GOP a 7-2 advantage in the state's congressional delegation. They felt it was sufficient, and structurally, they actively resented taking direct orders from Washington on how to draw state-level district lines.
See.
They defied the request, and 21 Republicans actually joined 10 Democrats to vote the new redistricting bill down.
So they chose local autonomy over national party directives.
And that defiance triggered a massive coordinated response. Trump turned an administrative map dispute into a pure test of loyalty. He demanded primary challenges against the GOP senators up for re-election who had voted no.
And the pressure campaign was severe. The reports detail intense grassroots mobilization, bomb threats, swatting attempts against the lawmakers' homes.
Yeah, it got really ugly.
And Vice President J.D. Vance even making 2 trips to Indiana specifically to pressure these state senators on their home turf.
The results from Tuesday's primary show the sheer effectiveness of that leverage. Of the 7 incumbents who defied the redistricting order and faced a Trump-approved challenger, 5 were defeated.
5 out of 7 established incumbents lost their seats to primary challengers over a map dispute.
If we look at this strictly from a structural, nonpartisan standpoint, it is a profound demonstration of the ongoing shifts within the GOP's internal power dynamics. It highlights the deep, enduring loyalty of the MAGA base.
Yeah, they really turn out.
They are highly organized and perfectly willing to turn out for low-profile, state-level primary elections to enforce strict party discipline, even against established conservative incumbents.
It's a vivid reminder that politics is never frictionless. It's about leverage, loyalty, and moving bodies to the polls. And speaking of moving bodies, there is a real-world reality that can disrupt absolutely everything we've talked about today. Let's look at the public health alert that just crossed the breaking news feed.
Yeah, this is a developing logistical and biological situation that definitely warrants close attention. The World Health Organization has confirmed an outbreak of the Andes strain of the hantavirus.
Hantavirus outbreaks are usually quite rare, right? And typically isolated to rural areas with rodent problems.
Very rare. But what makes the Andes strain particularly concerning to public health officials is that it is a specific type of hantavirus that can be transmitted human to human.
Yikes.
And the outbreak is currently localized in one of the worst possible environments for containment, a cruise ship. The MV Hondius is currently anchored off the coast of Cape Verde.
There are 8 confirmed cases on board right now, including 3 individuals who tested positive for the specific Andes strain. And notably, the cruise ship's own doctor is among the infected.
Which is a huge problem.
Health personnel in full hazmat gear are having to orchestrate complex evacuations from a stationary ship out in the ocean. It's a terrifying scenario for the passengers trapped on board.
It's a massive logistical nightmare. But broadly, it serves as another stark reminder of our macro vulnerability. We track AI productivity algorithms and central bank interest rates all day long, assuming the machine will just keep humming.
Right.
But a single localized biological event can freeze human movement and introduce sudden, catastrophic variables into the global system.
Which perfectly sets up the final piece of economic data everyone in the financial world is holding their breath for this week.
The April jobs report.
Yep.
Amidst all the AI hype driving the NASDAQ, the corporate rebranding of fake meat, the billions spent on currency interventions, the underlying question for the real economy remains, are businesses actually hiring human beings again?
We have been through an unusually weak stretch of hiring, and the market is desperate for clues about the true health of the labor market.
So, as you sit there, watching the NovaStream tickers flash across your screen today, what does this all mean for you?
Yeah, let's tie it all together.
If we pull all these threads together, it paints a picture of a profound modern contradiction. We live in a world where artificial intelligence is literally writing 2/3 of a massive company's code, generating record-breaking profit margins for the S&P 500, and converging network security in real time.
The technology driving the financial markets has never been more sophisticated, automated, or frictionless.
Yet the global economy itself remains entirely at the mercy of stubborn, messy human elements.
You've got interest rate gaps that require $30 billion garden hoses just to temporarily stabilize a currency.
You have highly coordinated political revenge campaigns that unseat state incumbents over district lines. You have consumers relying on their taste buds to reject lab-engineered meat.
And you have the ever-present threat of biological viruses interrupting global travel and human movement.
It brings us right back to where we started.
You look at the digital dashboard and it looks so beautifully clean. The green lines go up, the red lines go down, but the engine underneath that glass screen is pure, unfiltered chaos. And it leaves you with a critical question to mull over as you watch those numbers today.
How long can our tech stocks realistically remain priced for perfection in a world that is so deeply, structurally, and unavoidably imperfect?
Is the defining tension of the market right now. The code is perfect, but the world is not.
Spot on.
Keep your eyes on the NovaStream tickers, watch those crypto and index feeds, and more importantly, keep questioning the reality beneath the headlines. Thank you so much for stepping away from the raw data feed for a moment and tuning in to today's highlights of the day.
Thanks for watching.
We will see you next time. Have a great day.